In this market update, I'm going to talk about, is the market like 1987, give an update on the Thordex, and talk about why being proactive is more important than being reactive. Some people are comparing this downturn to 1987. Well, it really isn't like 1987 in one regard. And this is a chart that looks at the performance of bonds versus stocks from March 31st. And I remember this vividly. I was 1 year into the business. And what happened was you saw bonds actually get hit pretty hard. They were down over 10% in that 6-month time period, while stocks were up over 15%. And in October, when we had the crash, it was one of the worst days for the stock market, but it was the single best day for bonds. And you can see if you held the stocks versus bonds over that time period, you actually did better with bonds than you did with stocks, but it all reversed on 1 month. And that's not something that we're seeing right now. Bonds are actually holding up pretty well and have been the last several months. And so this market downturn is not like 1987. It was caused by this bifurcation in bonds versus stocks. Now, what is it like in 1987? And I'm going to talk about that here. And this is why I don't think the Federal Reserve is going to raise or lower interest rates in a meaningful way anytime soon. And this is what the Federal Reserve is looking at, inflation expectations. This is looking at a survey on what consumers are expecting for inflation. You can see here, over the last 10 years, the average has been 2.7%, and it's jumped up to over 4%. With all talks of tariffs and inflation, people are expecting higher inflation in the future. And that is not something that the Federal Reserve wants to see out there. They want to keep inflation expectations low. So let's take this chart out a lot longer, going back to the late 70s. And you can see in the late 70s and 1980, the inflation expectations were 9%. And the average has been 3.19%, but it's been below average from 2000 all the way until just recently. So the Federal Reserve, because expectations for inflation were low, were able to lower interest rates during some crises because there were no expectations for inflation. Now the expectation is higher, and if anything, where the expectations are is very similar to where we were back in 1987. So what that means is that the Federal Reserve is probably going to keep rates pretty close to where they are, and we're going to be more normal, is going to be more about a 4% inflation rate rather than inflation rate below 2%, which means interest rates will remain higher for longer. Now, people say, Jim, what is Thor doing right now with this market correction? Well, it's very important to know that we've already made our moves way ahead before the market corrected here. And we're going to be making moves in the future if the market continues. Our indicators show that they should. But let's look at what our indicators were showing at the end of March. The Thordex was at 68. So the market was still expensive. It did come down, but it was still very expensive. Our bond indicators on the right-hand side, we were longer duration, but not taking credit risk, not buying high-yield bonds. And you've seen the spread on high-yield bonds widen versus corporates that are high-grade corporates. And that's continuing, and that's not good for high-yield bonds. You've actually seen high-yield bonds underperform the rest of the bond market. And then on the bottom there, bonds were still attractive versus the stock market. So we were underweight equities in all our clients' portfolios going into this, except for our best ideas, which is always fully invested in equities. And we had alternatives in the portfolio, and our bonds were longer duration in the US and higher credit quality. And that has held up well. So we did our work ahead of time. We were proactive. A lot of investors look at it and say, hey, what are you going to do now? And they're reactive, and they're selling off into the downturn, which is not what you want to do. We're looking for opportunities.